In this video, I want to talk to you about index fund investing. And index fund investing is one of my favorite ways of investing my money if it's not already in dividend shares. Over the last 5 years, it seems like people are really trying to understand more and more about it. And I can't blame them, because when you put your money in index funds, it's low on effort, it requires very little skills. And people like Warren Buffett have been preaching about it for the longest time. And the best part is that when you put your money in index funds over the long term, you are likely going to outperform 99% of individual investors and 95% of hedge funds,
who are paid a lot of money to outperform the market.
Don't worry, I made this video to be as beginner friendly as possible. And at the end of this video, you would have built enough foundational knowledge to get started in investing in index funds. But I don't recommend you to get started straight away, because you need to do a little bit more readings to take into account your own circumstances and pick the right product for yourself. At the end of the day, I am not a professional. I am not sponsored in any way in this video. And everything that you can see and you can understand is all the research I have done when I first started investing in index funds. Approximately 13% of my portfolio is currently invested in index funds. As usual, if you enjoy content like this, it would really help me out if you can gently destroy that like button and subscribe to my channel for more content like this. And without further ado, let's go! So, what is an index fund? An index fund in its simplest form is just a portfolio of stocks and other assets that copy a financial market index. As simple as that. Now, an example of a financial market index is ASX 300. I'm using ASX 300 because I'm in Australia, and that is essentially the top 300 companies in Australia. Now, an index fund that copies ASX 300 will have the exact top 300 companies in their portfolio at all times. Now, another thing I wanted to mention is that index funds are just copying a financial market index. The fund manager do not actively pick what stocks that go inside the fund. They are purely just copying what's inside the financial market index. This way of investing is what we call passive investing. If a fund manager is actively choosing what stock that's going into the portfolio, that is what we call active investing. And if you look at the screen right now, you can see that one share in each of the top 300 companies will cost you $7,092.40 on the 21st of February 2020. Now, of course, if you're in other countries, they have other indexes that's quoted quite often, either on Wall Street or in other places. S&P 500 is another really good example that the US used to benchmark their performance for the economy. Now, index funds are very often interchanged with exchange traded funds, and they are actually different. And I will explain that in just a second. So before I explain the difference between index funds and exchange traded funds, let me quickly just explain how it works. How does index funds work? So let's keep using the index fund that copies the ASX 300 as an example. The index fund that copies the ASX 300 will always have the most up-to-date version of the top 300 companies in Australia in its portfolio at all times. But the position of those companies might change over time. Some companies might leave the top 300 position, and some companies might actually enter the top 300 positions for the first time. Now, if you remember in the earlier sections of the video, I mentioned that it is a fund manager's job to just buy and sell accordingly, to follow the index as closely as they possibly can be. And because that's all they're doing, this is one of the reasons why the management fees on most index funds are really low cost, and it's relatively safe as a type of investment, because all you're investing in is the top 300 companies in Australia. And plus, the effort on your side to manage this type of investment, you just have to put money in. You let the fund manager do the rest, and there's not much involvement that's required on your end. Okay, so now that you know what is an index fund and how does it work, let me explain the difference between a traditional index fund and an exchange traded fund. Now, an exchange traded fund is just a fund that is listed on the stock exchange, and they usually mimic an index or a type of asset, but that is not always the case, and it can be different. So to give you an example of an ETF that follows the ASX 300 is VAS a Vanguard Exchange Traded Fund that follows the ASX 300. The main difference when it comes to traditional index funds and ETFs is that ETFs usually have a lower minimum investment amount. With traditional index funds, you actually have a minimal investment amount of up to $5,000 or more in order to invest in that index fund. Whereas ETFs, as you can see on the previous screenshot, is that a share of VAS costs approximately $90 to $90.55. And ETFs are listed on the stock exchange, whereas traditional index funds are unlisted, and you can't buy traditional index funds off the stock exchange, which means that index funds don't have transaction fees. Every time you buy or invest in an index fund, you don't have brokerage fees that you will have to pay. Whereas for ETFs, because you're buying off the stock exchange, every time you buy a certain amount or you invest, there's a transaction fee that you have to pay. And one of the last main difference is that index funds are actually priced a little differently compared to ETFs. Now, ETFs is a little bit more straightforward in terms of pricing because they are priced based on how well or how the shares are performing in the stock market. Whereas index funds are priced based on net asset value. Now, if you're curious about net asset value, I'll pop the formula onto the screen now. And that's essentially the total assets of the fund minus the total liabilities of the fund divided by the number of shares issued in the fund. Now, if you want me to talk more about net asset value, just let me know in the comments below and I might do a more specific video on that a little later on. For me, I'm only human. I want to keep things a little simple. So I did go down the ETF route instead of the traditional index fund route. It's easier for me to understand, it's lower fees, and it's a lot more accessible for everyday people like me. Now that we've got the main differences between ETFs and index funds out of the way, at this point onward, I'm going to refer ETFs as index funds because they are exactly the same except for transaction fees and the minimum investment amount. Now, why invest in index funds? I can't speak for everyone else, I'll just speak for myself. Now, I'm invested in ETFs for two major reasons. And one of the first major reasons is that index funds over the long term is going to outperform majority of professional money managers. And if you don't believe me, at least hear it out from Charlie Munger, which is the vice chairman of Berkshire Hathaway, which essentially is Warren Buffett's business partner. He said, by periodically investing in an index fund, for example, the know-nothing investor can actually outperform most investment professionals. Paradoxically, when dumb money acknowledges its limitations, it ceases to be dumb. There's more than enough articles out there about Warren Buffett and Charlie actually preaching about index funds, so you can go read up on it yourself. And one of the other reasons why I am invested in index funds is because the amount of management that's required on my end is actually really small. I just have to put more money into my portfolio, and it doesn't require much. On my side, it doesn't require much time, and that's how I like to invest. Now, I talked a lot about the good things on index funds. It wouldn't be fair if I don't at least talk about some of the risks associated with index fund investing. Now, some of the risks is that index funds perform the best over the long term, which means that it's a marathon, not a sprint. And you have to continuously invest in that portion of your portfolio, whether the times are good or the times are bad. I think it goes without saying that any type of investment, there's a chance that you're gonna lose your money. But if you're willing to take a chance on Bitcoin, why not take a chance on something safer, like index funds, that would make you a millionaire over the long term? And one of the last downsides about index fund investing is that you might not like some of the companies inside the index. Now, the thing is, the index is tracking some of the top companies in the country. And there's bound to be some resources companies like oil, some fossil fuel type companies, pharmaceuticals, even tech companies. So if you have a preference when it comes to what companies you want to be invested in, make sure you do your own research on the index first to see if there's anything that you don't like. Personally, I don't have that preference. So you need to make sure you do your own due diligence to understand what's inside the index and whether you want to move forward investing in that index fund. Now, if you've gotten this far in this video, it probably means that you are somewhat interested in getting started with index fund investing yourself. And I'll dedicate this part of the video on a practical step-by-step on how you can get started yourself. But I just want to let you know that I am not a professional and you need to consult a professional if you want to get started investing because you know yourself best. Everything you see in this video is what I did for myself when I first started investing in index funds. And the first step is actually reading out more about it. And these are some of the materials that I found super helpful. Unshakable by Tony Robbins is a really good introductory read around markets. And there are plenty of conversations between Tony and Warren Buffett and Jack Bogle as well. Now, I want to highlight that Jack Bogle is the creator of the first index fund. If anyone knows anything about index funds, it would be Jack. Now, unfortunately, he's passed now, but there's plenty of materials that he wrote that is really helpful, not just understanding index funds, but also investing in general. Which brings me to the next book, which is The Little Book of Common Sense, Investing by Jack Bogle. Now, I don't need to talk too much about it, but if you're interested in any of the two books, I'll leave a link in the description below. Now, other materials that I found really helpful, as crazy as it sounds, is Investopedia. Now, Investopedia basically tells you all the facts around index funds, a lot of the fundamentals when it comes to the share market as well. So that's a really good place to understand the facts. And another place I found helpful is on Quora. Now, I want to say that Quora answers are written by other people across the world. Now, these answers are opinions, they are not facts. So I will always take Quora answers with a grain of salt. There are some really good material though on Quora around index funds, so I highly recommend you to go check it out. Now that you've read everything you need to know around index funds, you're ready to move forward, here are the next few steps that you can take. One of the first questions you need to ask yourself is, what is your investment strategy? And what that really means is that how long do you want to invest for and how much risk can you take on? So let me explain. When I did this video, I'm approximately 27, which means that I'm still very young. And because I'm young, I can take on a lot more risk and ultimately rebalance or change my portfolio later on in my life. Now, if you're much older, you might not want to take on as much risk because you want to preserve your wealth instead of taking the risk and potentially losing the wealth. So only you know yourself best. So you need to ask yourself, how long do you want to invest for? And also how much risk you can take on where you are in life right now. And once you've done that, you want to research some different fund options that will fit your investment strategy. Some of the key things that you need to pay attention to when it comes to researching different index fund options is that you want to ask yourself, what are some of the management fees per year? How did they perform over the last 5, 10, 20 years, even 30 years if the fund has existed long enough? Is there a minimum investment amount? Is the fund even available in your country? And whether there is any brokerage fees when you buy and sell. So for me, I'm invested into VTS, and VTS is essentially a Vanguard index funds that follows the total US market. And the management fee I pay per year is approximately 0.03%, and the fund has returned approximately 16% since 2009. There are brokerage fees when it comes to me buying and selling because it's an exchange traded fund. There is no minimum investment amount, and it's available in my country. Now that you answer what your investment strategy is and you understand what your options are and you're ready to move forward and purchase some for yourself, the next step is actually pretty straightforward. So if you're planning to buy traditional index funds, which have a minimum investment amount, there are providers such as BlackRock and Vanguard, and you can contact them directly and fill out an application online to get started. On that note, if you're planning to buy traditional index funds as well, you can actually access that via your financial planner. So make sure you do your own research if you want to go down that route. So for me, I went down the ETF route, which means that most ETFs, I can buy them on online share trading platforms. So I'm in Australia, I just have to fill out an online application. We have our own local share trading platforms here, but I think in the US, there's M1 Finance, Webull, and Robinhood. You're the lucky few, and they are incredible. For me here, there's a list of stock brokerages that we have access to. So I'll share that in the link description too. Thank you for watching this video all the way to the end. I would really appreciate it if you can just gently destroy that like button for the YouTube algorithm, and that will help out my channel out a lot. And also, if you really enjoy content like this, make sure you subscribe to my channel, click on the bell so that you'll be the first one to know when I release more content like this. And if you want to read in detail more about index funds, I actually wrote it as an article. I'll leave a link in the description below as well. And until next time, I just want to say thank you again because that really keeps me going. And I'm really grateful I have the opportunity to create these videos to relearn a lot of the things that I was taught in uni or something that I've tried for myself. That has really helped me grow as an individual. So thank you for that. And until next time, see you soon.